Haha, we're on. We're live. That's funny. I was just checking to make sure that this was going on. Still getting used to the new software. Welcome to Oregon Cash Flow Pro. How's everybody doing? Today we're going to be working on IUL illustrations. We're going to be doing them live. So if you have something that you want to see, put it in the comments. Let me know. And we'll design it right here, right now. And we'll put it up and take a look at the illustration. We had a really good response to our last couple of videos that came up. We put out a lot of good information as far as the IULs, things to look out for. Really, what we were focused on was, what's a realistic income that can come out of these things. What I want to take a look at today, if we don't end up with any requests, is we're going to look at National Life. National Life has a very popular IUL. Let me get into my National Life software. I'm gonna put something together. There's some interesting things to know. It's not a bad product. I own it. I've owned it for a number of years. I passed my break even in year 3. So it's not bad. It does have a little bit lower caps than some of the other ones these days. And when I bought my policy, I didn't have an uncapped index option. And I still don't have access to an uncapped index option. Their new product does. And it's a good uncapped index option, as well as they have a bonus now. Let me put this up. All right, let's do a new illustration. I'll just put my information in here. We'll take a look at what this might look like. So National Life, as far as from a design standpoint, we can do a 3-to-1 blend. So we're going to look at, let's look and see what $1 million death benefit will look like in here. First, we're not going to do any kind of a blend. Show you guys the differences here. Let's look at a design just like any other agent might design. An agent straight out of the education course jumps into an FMO and they say, here, follow this script, go talk to these clients. This is what we're selling. Okay. And if they want an illustration, we'll give you one. And the client says, okay, well, they want $1 million death benefit. Give me an illustration for that. Let's do. All right, so the MEC limit on this it would be a level death benefit, $1 million. The MEC limit's 21,000. So we're going to do 21,500 for our payments. We're going to do that for, let's say, 20 years. And then let's solve for an income stream. Beginning in year 21. All right, let's run this report. And I'll be able to put it up here in just a minute. So unfortunately, this doing these live, you're going to get a delay where you just get to look at me and not the actual illustration or me designing it. All right, let's download. Illustration. Level DB. I don't want that opening in there. Let's open it here. All right, here we go. Let's switch over here. So here's our illustration. Let me see if we can make this a little bit bigger for you guys to be able to see. Huh. All right, I think this works. So you can see we've got $1 million death benefit. Option A, we're putting in $21,500 a year. Let's see if we can get to the limits on here so I can see what those are. Here we go. So with the level death benefit, we've got your max non-mech, which basically applies for the first few years, 2 or 3 years that you can put in that much. But then it's going to drop down. How much you can put in is going to drop down because your average is actually going to be this number over here. This is our guideline level premium. Let me see. Can I highlight this? There we go. So 21,514 is the guideline level premium. We're going to put in 21,500. If we put in 68, which was this number over here, if we put in this one, we could do that for a couple of years, and then it's going to drop down because the average cannot be higher than this 21.5 once we get to about year 5, okay? Otherwise, we'll violate the mech limits. Now, this is a high commission design. We haven't done anything special. This is, you could go to any insurance agent in the country and get a design like this, okay? Target premium, remember target premium? Agents generally make about 100% of target premium for their first year commission. Now, there's more than that that gets paid out in expenses among everybody that's going to make money because the FMOs make money. There might be some hierarchy in there where somebody gets an override. But in general, we just know that target premium essentially tells us how much commissions are going to get paid out. And the higher target premium is, the lower you're going to have for cash value. Okay, the bigger your expenses. So let's keep going down. Let's take a look. One of the nice things about the National Life product is their riders. It's one of the things that makes them popular. They have 4 living benefit riders. And we'll see those here soon. So we've got our guaranteed values. We usually just ignore those. Guaranteed values assume no growth in the index ever, as well as the highest costs. So if there's room that the insurance costs can go up, it will assume those costs are at the highest they could be. So we want the current illustrated values. So we've got current. Oh, did we have current here? Yeah, we had current over here. So this, because I made this screen bigger, we're seeing 2 pages at the same time. So right here, no cash value in year 1. We do start to get cash value in year 2, but the difference between the accumulated value here and the cash value is your surrender charges. So in year 2, we've got 19,000, no, 21,000 in surrender charges. The bigger the commission that you pay out, the higher the surrender charges are going to be. Okay, now National Life has a 10-year surrender charge period. So we can see here in year 10, there's still a small difference between these two values. It's still about $3,000, $2,500 or so, $2,600 in surrender charges. And then in year 11, those go away. So these two numbers, our accumulated value and our cash surrender value, are the same. Those will stay the same for the rest of the policy until you start taking loans. And depending on what type of loan you take, if you take a participating index loan, then these two numbers will again separate. Because this column is what the growth is going to be based on. And this column is essentially what you have available for your walkaway cash value or as your line of credit, what you can borrow from. Yes, Joe, this is a bad policy. So this is a level death benefit, $1 million death benefit, and it pays out a huge commission. What did we see? It was like $16,000 commission. Okay. And we're only putting in 21,000. So most of the first year funds that you're putting in goes out to commissions. This is not the type of policy we like to sell. It doesn't give you much flexibility. Okay. If you have a financial emergency and you can't make your next year's payment, you lose everything. You have no cash value, right? That's terrible. I don't like to sell policies like this when there's like that. To me, that's way too much risk because we just don't know what's going to happen. Okay. So that's the beginning of it. Now let's look down the road. It looks like we start an income stream. This is a projected income stream of $58,675 a year. Look at this cash value. This is my biggest issue with a National Life illustration is how low that it lets the cash surrender value get to when you're taking loans. And we put in participating index loans in here. Okay. Participating index loans. You can see here, it draws it down to about $38,000. Now, if we've been taking $58,000 a year out for the last 30 years, that means we've got over 3 million in loans. And there's only 38,000 in cash value. This is where the criticisms can really come in on these illustrations, because if you get a 0 year, you're sunk. That policy just lapses. Unless you can pay, 5%? Illustrated loan rate's 4.6. So 4.6 of 3 million. 120,000. $140,000 in interest that year. There's not enough cash value to support that. So this is a very risky proposition when we get into this area. Remember when we looked at National Life last week, the lowest the cash value drew down to was like $400,000. A lot more flexibility in that case. It doesn't run it down to almost nothing. And there's some carriers that will run this down to 0 and assume you're going to trigger that overloan protection rider. So you got to be aware of what you're looking at with your carriers. So I don't like to run this type of an illustration with National Life where we run that cash value down to almost 0. I generally prefer not to show an income stream, but it's good to have an idea of what's possible, right? So in this scenario, this is a bad design, high commission. We're not able to put in a whole lot compared to the underlying costs. We're limited at $21,500 because we didn't do an overloan, or we didn't do the increasing death benefit. Or there is an alternative. You can use a different MEC test. So there's 2 different MEC tests you can use. There's a guideline premium test, and then there's the CVAT, the cash value accumulation test. If we use the cash value accumulation test with a level death benefit, our MEC limit is determined by that MEC, the 7-pay MEC test, which is higher. So we end up being able to put in quite a bit of money. With some carriers, they're other implications that leads to. But in general, the only downside to going with that is you have to have a higher amount of insurance throughout the life of the policy. So the net amount at risk is higher than in an increasing death benefit with the guideline premium test. Almost lost my train of thought there. So let's see. Let me get out of this. Let me see. Minimize. So what we're going to do is we're going to switch over. I'm going to do another illustration. We're going to do this exact same one. We're going to switch to an increasing death benefit. We're going to do increasing for 20 years. And then we're going to reduce it. Now, by switching to increasing, our MEC limit just went up to $57,900. So we have two choices here. If you have a policy that you actually want $1 million death benefit, if your goal is $1 million death benefit, which design you go with is going to depend on how much you actually want to contribute to the policy. If you only want to put in $20,000 a year, you might do the level death benefit. There's no reason to have that MEC limit be higher if you don't think you're ever going to want to put in more than that $21,500, which was our MEC limit. If you want the flexibility to do that, then you might go with an increasing death benefit, have the ability to put more money in. That's if your goal is, right, if you want $1 million death benefit. If your goal is to just put in $21,500, we would go with a lower death benefit and have an increasing death benefit. So I'm going to reduce this death benefit so that we're still putting in, let's assume the goal is you want to put in $21,500. So we're going to have MEC limit of $21,500. And it looks like it's about $400,000 death benefit. Not quite that much. $375,000 death benefit. That'll do it. All right. Everything else is going to be the same. Here we go. Oh, good. I prefer to have one page on here. All right. So here at the top, we can see it's now an increasing death benefit, $375,000. And we're still putting in $21,500. So this is optimized for cash growth instead of death benefit. Let's get to our limits. Here's our limits. You can see our guideline level, slightly higher than the 21.5 that I set up. The max non-MEC is at 25, obviously quite a bit lower than the other one. The other one was based on $1 million death benefit. Let's see, page 13. The max non-MEC on the other one was $68,000. So you could put a lot more in that first year in the other design, but it would reduce what you could put in for a number of years. Okay, the actual MEC limit is 21.5 on the other one, 21.7 on this one. Let's look at the growth. This is still, oh, hang on a second. Let's look at the commission. This is still a high commission design. We did not optimize this yet. But instead of $16,000, because that other one was based on $1 million death benefit, this one is based on a $375,000 death benefit. So your commission, $6,300. So what we expect to see is a lot lower surrender charges, more cash value in the first year than in the level death benefit design that had higher expenses, much higher expenses, and much more surrender charges. And here's our current rates. 11,000 cash value in year one. You can see the difference between the accumulated value and the cash value is about $8,000. So we've got an $8,000 surrender charge. In the other design, we were at a $21,000 surrender charge in year two. We're at $8,000 in year two in this design. We're still putting in 21.5, but we paid way lower commissions. All the other assumptions are the same. You can see our potential income goes up to 66,000. The other one was at 58. So we're at 8,000 extra per year. But again, let's look at the cash value. How low does it draw it down to? Around 44,000. So too low, in my opinion. The other one drew it down to 38. So in a number of areas, this one is still better, but not a position you would want to be in, where you've got $4 million in loans and 4,000 in cash value. Okay, that's not very realistic risk that anybody should be taking on, right? Let's hop to the expenses. Take a quick look at our policy charges ledger. Okay, here's our policy charges. We've gone through the policy charges before, but I'll go through them again here briefly. Your premium expense charge, that's your load fee. We have our cost of insurance. We haven't done any type of a blended design, so it's still all in the cost of insurance. Although with National Life, even when we do a blended design, I believe they still put all the cost under the cost of insurance. You can see really low cost of insurance to start, and it just goes up every single year. We don't have any other riders attached, so there's no other costs of other benefits. You have your policy fees. This is your documentation fee. That's every year in the policy. The premium expense charge, this load fee, is only charged when you put in money. So you can see here, when you stop putting premiums in, there's no load fee. So those go away at that point. Okay. Your expense charge, this is where they recoup the commissions, as well as any other expenses that it took to start this policy. That might be underwriting charges, medical exams, not underwriting charges, but the expenses to do the underwriting, medical exams, ordering the medical records, and then, of course, all the commissions that go out. So like all of those charges get recouped over a number of years. Remember, they're paying about a $6,000 commission to the agent in year one in this policy, but they're not going to charge it to you all at once. They're going to recoup it over a decade in this case. Okay, and then that goes away. So the charges are front loaded here. And then we have our accumulated value charge. National Life charges a 0.35% accumulated value charge for 25 years. And then that goes away. So this is affected by how much the account value is. Okay, and then it goes away. It's a fairly low percentage, but you can see if you end up with a bunch of cash value in here, it's a decent number that adds to your expenses. Okay, that's just one of the ways that National Life kind of makes up for maybe what they present as a lower cost of insurance throughout the years. Overall, the overall policy charges are still relatively low in the whole scheme of things. Okay. There are other carriers out there. This accumulated value charge is 0.72%. There's even one that's 1.25%. Those are significant. This one's relatively insignificant. Okay. Let's look at the expense charges on our previous design. Remember, much higher commissions. Here we go. So here's the original design. Level death benefit, $1 million, much higher commission. Look at these expense charges. 3 times as much. Cost of insurance, obviously it's about 3 times as much insurance. So our cost of insurance tripled. The expense charge, exactly the same. Policy fee, exactly the same, because we're still putting in the same amount of money. The accumulated value charge should be a little bit lower in this one because we're going to grow cash value slower because we're paying for more fees. Total policy charges. Look here, by year 10, this one's at 68,000. This one's at 37,000. That's a big difference. So in 10 years, we're at $30,000 difference in policy charges. And that's optimizing for cash growth instead of death benefit, right? We just reduced the death benefit. We still haven't optimized this policy though. So let's do that. Let's see if I can leave that over here. And now we're going to do our blended design. There's 2 steps to optimizing an IUL. First is we're going to design it for a minimum death benefit based on how much you're putting into it. So we want to design it around that MEC limit. The second way is we reduce the commissions. And we do that by doing a blended design. So we're going to put in, let's do 100,000 on our base face and 300,000 additional protection benefit. That's the rider. That's the supplemental term rider that National Life uses. It's called additional protection benefit. You can do a 3-to-1 split design. And actually, I don't want to do 100,000. That's not quite optimized. We get a MEC limit of 22,856 if I do 400,000 death benefit. So let's do 375. So we need 93,750 for our base face amount and 281,250 additional protection benefit. Oh, not quite. We're going to go 94, just under 21.5 for a MEC limit, and 284. No, 286. 286. Oh no, 282. 282. There we go. 21. Oh, we're still not quite there. 21,489 is our MEC limit. We're so close. Let's go 9 for 100. 282. 300. Does that get us there? There we go. All right. So this is now our design. We have a total of 397. No, not quite. What are we at here? 94,100 times 4. 376,400 is our death benefit. Let's run the report. And here's our new illustration. This is now optimized for cash growth. For an amount to put in $21,500 per year. Here's our numbers. You can see our MEC limit, 21.5. Target premium, $1,500. Our original design, level death benefit, $1 million with a MEC limit of 21.5. Commission was 10 times higher than this. It was $16,000. By optimizing it, using an increasing death benefit, reducing the commission by using the additional protection benefit rider. If you look up on the right here, you see this APB under the riders. If somebody tells you they're giving you an illustration that's optimized for cash growth and you don't see this APB in a national life policy, it could be better. Okay, $1,500 commission. Let's see what that does to our cash value. Now we're going to look at the cash values in this. Again, we're going to look at the income projection. And then from here, what we're going to look at is how can we make it a more realistic, a safer income projection? Okay, there's a couple of things we can do here in the National Life product. Here's our cash value. Let me do that same page we were looking at on the other ones. I think I went past it already. No, maybe I didn't. Here we go. All right, 18,000 in cash value in year one. Do you remember what we were in the other one? In the original design with the highest commission, no cash value in year one. The accumulated value, 16,000. In the second design, where we kind of optimized by increasing the death benefit, and there's people out there, there's some YouTube personalities out there that want you to think that this is all they needed to do to make this a great policy, that makes this an optimized policy. Switch it to an increasing death benefit, lower that face amount. And they're doing their fiduciary duty. From a fiduciary perspective, they just did. They're not required to reduce their commissions. Being a fiduciary does not require you to reduce your commissions. So this would be the optimized design where you get 11,000 in cash value in year one. The accumulated value, 19,000. Okay, so we went from 0 cash and 16,000 accumulated to 11,000 and 19,000 in accumulated value. So it just got better by $3,000. That sounds like a pretty good deal. And it's better, but it's not the best that you can do. What does our best design do? 18,000 in actual cash value, 20,000 in accumulated value. So we're actually $4,000 higher here, 18,000 higher than the original, and $7,000 higher in cash surrender value. When we minimize the commissions, the surrender charges become very low. Notice the surrender charges are right around $2,000 to begin with. In the worst design, the surrender charges was over $2,000 in year 10. In this case, they're down to like $200, $250 by year 10. This is the kind of flexibility that I love to see in a policy. If for some reason you're not happy with this product, you've been in it for a number of years, you've given it a chance to succeed, your surrender charges are very low. You don't have to wait all 10 years. You're not going to lose very much by switching out of it if it's only a couple $100 surrender charge. You know, you're going to be much more comfortable getting into a better product and paying a couple $100 as opposed to paying thousands, many thousands of dollars to try and get out of something that wasn't designed properly. So there's a number of reasons why I prefer to do my designs like this. And it's not because I don't like money, because obviously the commission is way lower. But I find these to be a lot more attractive to people. We can sell a lot more of these without having to actually sell. Like, we don't have to engage in any manipulative sales practices in order to sell this type of a design. Like, this is an attractive design. Let's look at the income projection, 69,000. So that's another 3,000 higher. I believe it's 3,000 higher. What were we at on this one? Yeah, this one was 66,000. So it went from 66 to 69. In the worst design, we were at 58 to start with. All these too high for the designs, in my opinion, because let's see how low it draws it down to. In this case, it draws it down to 45,000. This happened to be the best as far as the drawdowns of these three designs. The second best design drew down to 44. The worst one drew it down to 38. This is still way too risky to be considered realistic. Okay, so let's look at the alternatives for an income. What might be an actual realistic risk representation? There's two options with National Life. One is you just do your standard loan. That's your wash loan. Okay, we're just going to do your standard loan. Oh, what happened? Hang on a second. Caused a mech. I think it must have been a mech prior to me doing those loans. So maybe that last design was a mech. Let's fix that. Let me double check here. Yeah, we have a mech in year 20. That's because of when I'm making these changes from an increasing to a level. So we just need to make the change year. 21 instead. I should not have mech'd. Why did it mech? Okay, well, I changed it the next year. It got rid of the mech. We're still at 69,442, which is actually a little higher income. That's interesting. All right, well, we got rid of our mech. All the numbers are essentially the same, except we made the change 1 year later to switch from the increasing to a level death benefit. Always want to watch for that. I didn't do my quick view to check on that. All right, so let's go to the different income design. We're going to do a standard loan. This is our wash rate loan with National Life. We're still doing the income solve. But in this case, our loans are not going to outpace our credits. When we do a wash loan, you're going to get a corresponding credit to the cost of the loan. We're not assuming any arbitrage in this case, and we don't need to. And it does away with the risk that you're going to get. Here's our numbers. You can see same as the last one. This is for the optimized design. But with this type of a loan, here's our projected income, 49,000. Oh, what happens here? Oh, this is the guaranteed values. Ignore the guaranteed values. So 49.4. Let's look at what happens to the cash surrender value. Okay. Now what's happening in here is we're going to start taking loans. And as we take a loan out, the amount that we're borrowing, we're going to pay approximately 2%, and we're going to get a credit of approximately 2%. Okay. Or in this case, maybe 4.6 and 4.6. Okay. Either way, it should be a wash. We're going to get a corresponding credit. You see our cash value holding steady, coming down a little bit, but not very much, because we have an aggressive amount that we're withdrawing. Okay. We're past 96. At 96 on the last ones, we were down to 38,000, 44,000 in cash surrender value. If you had a zero that year, you're done. The policy lapses. You have to trigger that overloan protection rider and you have no more income. In this situation, you still have almost $600,000. We're pulling out $49,000 a year instead of $66,000 a year. A lot more conservative projection. And we don't have any of the risks that the other projection offered. Okay. This does not get down to zero until maturity, age 120. That's what this is designed to do. We're going to aggressively take out an income stream until we pass away, or age 120, whichever comes first. Now, if you happen to live past age 120, you would probably trigger your overloan protection rider somewhere up here. Triggering the overloan protection rider costs a little tiny bit of money. I don't know if leaving 237 in here would allow that to happen. So you might trigger it the year before. Does National Life charge interest on the loan amount at the start or end of the year? Chris asks. I believe it's at the end of the year. It's at the end of the year. Most of your IUL carriers charge it at the end of the year. All of your IUL carriers and all of your whole life carriers, whether they say they charge at the beginning or the end, they're going to make sure that you don't borrow enough that you can't pay for that cost of insurance. So usually if they charge at the end, they're just showing you a lower cash surrender value than they otherwise would, or the amount that you can borrow, because they want to make sure that the loan interest has the ability to get paid. So I don't usually pay too much attention to whether they're charging at the beginning or the end of the year. There's generally not much difference. You still see approximately the same cash surrender value. That's a reflection of the loan interest that's going to be due for that year. Okay. But in my policy, I get a bill at the end of the year for my loans with National Life. So this is a much safer income amount. National Life does give you the ability to do one other type of income, and this is a guaranteed income. This income is not guaranteed, okay? So when I say not guaranteed, that means when you start the income on this one, there's still some assumptions being made in this policy that it's going to earn about 5.82% every year in this policy. And based on that, these are what the numbers allow for you to pull out. So it's possible that, let's say you get into retirement, you pull out that for a number of years, and then suddenly the market goes stagnant and you get zeros for a whole bunch of years. Not likely to happen, but let's say it does. This number, you could run out of money if you continue to pull out that same amount. So the alternative is a guaranteed income stream. And essentially what National Life offers is the ability to turn it into an annuity. It's going to be a lower number than we see in here for sure. We call it the lifetime income benefit. And let's put that PDF up here. All right, here we go. So this is exactly the same as our last one. The only thing we changed is we changed it to a lifetime income benefit. Let's get to our MEC limits. Here we can see exactly the same. Commission, nice and low. There's our guaranteed values. Here's the ones that matter. You can see it should be exactly the same for the first 20 years. The only difference is once we start to take income, so beginning here in 21, 37,000. They've annuitized. They've essentially annuitized your cash value. They're going to guarantee this. Okay, it's going to slowly deplete your cash value. In fact, it depletes it faster than in the case of the other one because we've annuitized this thing. So like the cash value is just going to keep going down. Okay. But when the cash value gets down to almost nothing, you're still continuing to get that same amount because it's guaranteed. And look, the cash value just holds and holds and creeps up a little bit here. So I'm not a huge fan of this design. It is the absolute safest though, because you get that guaranteed income. Okay. There are some variables with the other one, but we could potentially pull out 12,000 more per year. These are not decisions you have to make when you first start your policy. This is a decision you would make when you decide to get your income, when you start pulling income. Now you could do the annuitized option at any point, even if you started with the other option. It's just going to end up being a lower number if you've already borrowed from it. Okay, but we're going to take into a factor, what has the index actually been doing? What do we think the policy might actually perform at based on what it's been doing for the first 20 years in the policy? Any of the changes that we illustrate are not automatic. Your policy holds steady until you make a change later on in the policy. So in this case, you could continue to put $21,500 a year longer than year 20. In fact, you could put it in up to age 99 if you wanted to. We just wouldn't change the death benefit from increasing to a level or reduce it until you decide you're done funding it. You could even stop putting in for a couple of years and then refund again, right? As long as we haven't reduced that MEC limit by changing the death benefit, you have the ability to do that. When it comes to what you're going to pull out for income, these are just projections. You're not forced, other than this one, which is guaranteed, and this is what you're turning it into. You're turning it into an income stream. In these other ones, in this one, you might pull out $49,000 a year. You probably won't. You'll probably pull out a little bit each month to cover your living expenses. Maybe you're going to pull it out to help supplement other retirement accounts that you're also depleting. You know, you've turned into retirement income. So realistically, you're probably not going to pull out the exact same dollar amount every year. You're not going to do it annually. You'll probably do it monthly. And these numbers will absolutely not be exactly what we see in an illustration. It's just showing what's possible. And remember, the best thing about an illustration is the ability to see how it compares to other products. That's really where we get the most value. How do these things work inside of it? What the charges, potential charges look like? We like to make similar assumptions across products. If you just max out and put in the maximum amount that a product will allow you to show, you're not going to get a very good representation among the different products, other than possibly the one that illustrates higher is allowed to illustrate higher because the indexes that they offer at the cap rates they offer or the participation rates have historically performed better. That is a possibility. But it also could be possible that there's some manipulations going on where a carrier is doing something to manipulate the regulations around the illustrations. So we went over that in the response to Life 180's video with the Allianz, right? We went over some of the things that do that. We do have AG 49B that's going to be coming out. I believe in May is when it goes into effect. We haven't seen all the implications yet, but essentially, let's go to the returns. Here we go. So essentially what it's going to do is it's not going to allow loan arbitrage to be shown in these illustrations. That's a good thing. And it's not going to allow carriers to just create index options that have no history. They've just got back testing that perform better than their S&P, whatever their S&P cap is. And it allows them to illustrate higher numbers based on the growth in the hypothetical index that was basically just created and it has no actual history, and adding a bonus to it that may or may not be guaranteed. Okay, now there are bonuses out there that one carrier in particular, they do a 1.65% bonus that the current values say they're going to raise it to 2.65 after year 10. But there's no guarantee for that. They only guarantee 0.5% for the life of the policy for that bonus. But their illustrations are allowed to show 1.65 for the first 10 years and 2.65 after that. It's ridiculous. It makes the illustrations look really good. But that is absolutely a way that they manipulate the regulations in order to show a better illustration and entice people with better looking numbers. Now, one of the ways we can recognize if a company is trying to manipulate is, does their index option, the average that they're showing, is it higher than their S&P cap option? So the current cap, 9.25% on the S&P option. Maximum illustrated rate, 5.92. The US pace setter, limited to that same number, 5.92. Credit Suisse. These are the two uncapped options. They're both limited to 5.92. So this is not using an index option to try and manipulate to illustrate higher than what the S&P index would. Now, they do offer a higher bonus for these two options. That's a reflection of the lower cost of options. Now, with National Life in particular, their bonuses don't kick in until after year 6 or in year 6. So something to remember. But they do offer some bonuses. These are bonuses that are not available with my policies. I got my policies 4 years ago. Maybe it was 5 years ago now. And they didn't offer bonuses. They didn't offer the uncapped index option. So I'm still stuck with essentially these options over here, which is kind of annoying. I really like having access to uncapped index options because you can see some of these years were really good returns. These volatility indexes in particular, I like to have access to because you get a high percentage participation rate and the uncapped. So on the years that do really well, you have the option to really outpace. You can see the average, the 10-year average on this one, 6.86. That's higher than our capped S&P option. Credit Suisse, slightly higher. Okay. A 20-year average, 8.92 as opposed to 6.25. Credit Suisse, 6.86. So much better long-term averages here. Even in the short term, 7.73. So I'm all about averages. I don't want to be trying to time this stuff, right? It's really hard to time the market. They say the best investors in the market are dead people. The second best investors are people who forgot they even had an account that's in the market because you don't touch it. If you don't touch it, you end up doing better. That's essentially what history has shown, right? You tend to do better if you don't touch it. Trying to time the market is very, very hard. If we try and bounce around to different index options, trying to time the market year to year, trying to get the best one, your odds aren't good that you're going to make the good picks. So in general, what I like to do is, what are the best average ones? That's the one I'm going to go with Because if we can get that average, if they can maintain that average, I'm going to be happy with it. That's essentially how I like to look at these. Okay. So obviously with the S&P cap at 9.25 and having a long-term average of 6.25, that's a decent return. That's better than what we're illustrating. Remember, we're illustrating 5.92. But it's not as high as some of our other index options out there, namely our uncapped, pace setter, even the Credit Suisse. Historically done better, and you get the bonuses. These numbers do not include the bonuses. So we get the bonuses on top of that. And then we remember, if we recall the Allianz product last week, even better long-term averages from our uncapped index options. So hopefully this was helpful. Do you guys want to see anything in particular? You got any questions? Anything you think, oh, what happens if you tweak this part of this illustration? What is the impact of that? We've gone over the worst design. We've gone over slightly optimized, and we've gone over the optimized design. And then we went over the income options from really aggressive, drawing down the cash value to almost nothing, very risky loan amounts in that one with participating index loans. And then we've shown wash loans, and we've shown the guaranteed payouts, where it essentially annuitizes. So we've gone over a number of different things. I think we've covered quite a bit with regard to these National Life ones. So any questions in regards to that? I mentioned earlier, one of the big draws with National Life is the living benefit riders. Let's take a quick look at those. We've got your overloan protection rider, very similar to the Allianz one. You can exercise it after 15 years or age 75, whichever is longer. Jose asks, what is the best company to do this? It oftentimes will depend on what your funding level is and what your overall goals are. The best product out there, in my opinion, right now is the Allianz product, which we went over extensively last week. And you can see in my video, I put out 2 videos last week that was a response to Life 180, their Allianz illustration review. Check that one out. That one goes very in depth on an Allianz illustration. And that design was a good design. Kelvin, are you asking Chris a question? How would you compare Allianz to NLG? What's 10-year average on NLG? So I'm James, just so you know. Allianz and NLG, Allianz has a better performing product, but it does depend on how much you're planning on putting into it. So I generally look to Allianz if we're putting a good amount of money into it. If we want a death benefit that's 500,000 or higher, Allianz is a good one. Not if we're shopping for a death benefit, but remember, we're going for cash growth. If we're just looking for a death benefit, the National Life, the cost of the insurance is lower. But when we get into the blended designs, we can end up with much lower costs with Allianz because they allow a much better blend. So I talked earlier, I don't know if you were here earlier when I talked about it, but you can do a 3-to-1 blend design with National Life. With Allianz, we can do a 10-to-1 blend design, which means with National Life on a 100,000 base policy, I can blend in 300,000 of term. And my commission is based on that 100,000. That's the 3-to-1 split. If I'm doing $1 million death benefit with National Life, my commission is going to be based off of a $333,000 death benefit. No, that's not right. It's a $250,000 death benefit. $250,000. So my commission's 2.5 times higher than otherwise would have been. It's still an optimized design for National Life. But with Allianz, I can do a 10-to-1 design. So I can do a $1.1 million death benefit, and I'm going to make the same commission as if I just sold $100,000. So Allianz really starts to shine when we get into those higher blended designs. Now at $1 million death benefit or 1.1 million, you're talking a MEC limit of $60,000+ a year. So those are policies that you're going to want to be significantly contributing to if you want to take full advantage of that split that we can do. If it's a kid's policy, it might be like $30,000 for that much death benefit. Really good opportunity, but that might be too much for a lot of people. I generally find National Life to be the better choice at very low contribution amounts. So if somebody wants to just put in $50, $100 a month, we can do a better design policy with National Life, because National Life will actually allow me to do a lower minimum. National Life will allow me to do a $25,000 base face amount, and then we can still blend in $75,000 of supplemental for a total of $100,000 in death benefit. That will work out better than the Allianz one, which just has $100,000 base, because in that design, I'm going to get paid a commission based on $100,000 with Allianz, and I'm going to get paid based on $25,000 with National Life. So there's a little bit of a difference. I always like to run the numbers though. If anybody ever meets with me and we've got a, if we have any question about which ones are better, we just run the illustrations and we find out. Let's let the products tell us. Let's design them the best. And then we'll talk about the differences, because there's going to be some situations where it's very close. If it's very close, even maybe National Life looks like it might outperform it, I might still recommend the Allianz product, because we're limited on what we can illustrate, but the index options have a much higher return. We have better bonuses that begin right away. The bonuses with Allianz start in year 1, not in year 6, like with National Life. So there's a big difference there. So if it's close at all, I would lean towards the Allianz one. It also depends on, if people want to increase their contributions down the road as well. So those are all things that we'll take into consideration, but those are more specific to you. And if we actually get together and we talk about these things, we'll go over that stuff. The main thing that we wanted to look at today, and what we're going to do on these Tuesdays, is how can we best design for this company? And then, of course, we can do some small comparisons between other companies. But like when it comes down to you making a decision and getting advice from the agent, there's a lot more things to involve. There's a lot more things to consider than just strictly what numbers are we seeing on that particular illustration. You're welcome, Jose. Chris asks, is there an impact of bank failures on proprietary indexes? Not that I'm aware of. That's a good question. I'm not aware of any indexes that were basically ran by those banks that have failed already. There could be some out there. I'm not familiar. I'm not aware of it. Like Fidelity, Fidelity is not a bank. Fidelity has an index. They run a volatility index that F&G takes advantage of. Bloomberg's not a bank. Bloomberg has a really popular volatility index and other indexes that carriers use. PIMCO, not a bank. PIMCO operates a number of index options. This one, though, maybe you're asking because this one's a Credit Suisse one, isn't it? I just now thought of that. I've actually switched to using the US Pace Setter mostly, but we have the Credit Suisse balance trend. That's an interesting question. I wonder if the Credit Suisse problems that happened this week might have any effect on that. I wouldn't think so, because the banking side should essentially be different than this, which is the investment side. Obviously they overlap some, and there could be problems there, but that's a good question. You got me stumped. I'm gonna have to take a look at that. And it's really because of this Credit Suisse. That's the only one I'm aware of that's tied to one of the banks that have just had problems within the last couple of weeks. Interesting. Good question, Chris. Dale asks, even though illustration numbers will not be the same, it is actuarially sound and obligated by the carrier. Right. With the exception of failure to pay premium and lapse. No, or MEC. No, these are not obligated by the carrier. The guaranteed numbers would be, but the guaranteed numbers are basically so ridiculously low. I just ignore them. The guaranteed numbers assume 0% growth in the index ever. So that's the only obligation to the carrier, is to meet those guaranteed numbers. So really the best use of illustrations is in comparing to other products. That's really how I look at it. But then of course we got to know how to compare them. We want to make sure we're looking at the same things. We're making the same types of assumptions so that we can compare them effectively. So even the almost everything in your illustration is based off of current numbers, current practices even. So cost of insurance has a current value. There's a current cost. That may not be the same as the guaranteed amount, and it's almost never the same. Nobody's at the guaranteed rates right now. They all reserve the right to raise the insurance costs a little bit. And that's dictated by your contract. Your contract will have a maximum number that they can raise the interest or the insurance amount, the cost per thousand. But that's not going to match the current one. And there's some carriers that have never increased the cost of their insurance. There's other ones that have maybe increased it, a couple of times, but, not by much. When we went through COVID, none of these carriers increased their cost of insurance. It wasn't really much of an impact. There was obviously some impact to lives, and a lot of people died when they shouldn't have, or earlier than they should have. But it didn't affect our actuarial numbers. So we didn't see insurance companies raising costs. There were other things that happened that caused them to raise or to make changes. Like we had some carriers that had to switch from mutual to stock companies and basically reduce dividends down. Things like that happen. Oh, you heard analysts say PIMCO and Invesco were two major investors in Credit Suisse. The effects will be far and wide. Allianz uses PIMCO and National Life Group uses CAD index, which is why you asked. Okay, well, I'll look into that. That's interesting. PIMCO is huge. PIMCO manages like $2 trillion plus. I think maybe not that much. I know Allianz manages that much, and Allianz owns PIMCO. Allianz is over $2 trillion in management. So it's not surprising that they would have a bit of money in Credit Suisse. I haven't even followed all of what's been happening with Credit Suisse, other than I heard that I think UBS is stepping in and going to help cover Credit Suisse so it didn't go out of business, right? So we'll see how the effects will be to our index options. But the index options, so there's a bunch of different things out there. You've got your volatility indexes. PIMCO has a bunch of different indexes, just like Bloomberg has a bunch of indexes, and those aren't necessarily volatility indexes. So some indexes will likely be affected more than others. You're going to have different buckets and different index options. And yeah, so just because PIMCO might be affected by Credit Suisse in some areas doesn't mean that their volatility index option is going to experience a major impact. That will be interesting to see, though. Interesting to see. Another one of those risks that the IUL represents compared to whole life, I guess, right? Because there are investments out there. Now, I guarantee you there are some insurance companies, that whole life companies, whose general fund accounts are going to be affected as well. Because, yeah, they're mostly in bonds, but oftentimes they'll have bonds on businesses as well. And there could be junk bonds mixed in there. Not generally much as far as junk bonds, but there could have been bonds that weren't junk bonds that turned into junk bonds. But insurance companies like to own other businesses. That's like part of how their general fund accounts operate, right? So there could be an impact there. It'll be interesting. It'll be interesting to see how this all plays out. Okay, yeah, CS. I figured you meant the Credit Suisse there. Good question. Good question. Any other questions? Darius, how's it going, man? Hope you're doing well. Any other questions? Otherwise, we'll wrap this up. And we're going to be back again Thursday for Whole Life. So Tuesdays, we're going to do IUL, live illustration designs and analysis. Thursdays, we'll do Whole Life. And we're going to work in getting my policies up as well. I almost did mine this week, but I don't know how to do it with the software that I'm using right now, without basically revealing too much information that probably shouldn't be put up on video out for the public like this. So once I figure that out, we'll be doing my illustrations. I might have to just do my in-force illustrations and then black out some stuff. So we'll see. We'll see. But I do want to do an update on my policies. Usually I just do it on my software, and it's a lot easier for me to control. So I may end up doing it that way, and then I can just share with you guys that video that'll already have it all blocked out. Whatever I need to black out, it's blacked out for privacy purposes. But those are coming. If you guys have anything you want me to see, if you have a policy you want me to review, you can sign up for a meeting with me at my Calendly link. I'll put that link here in the comments. If you want it reviewed live on air like this during one of our Tuesday or Thursday meetings, you can just send it to me, email it to me, and let me know that you would like to see it done live. We can do that. So we're up for doing policy reviews on these Tuesdays and Thursdays, IUL and Whole Life, and illustration design. So illustration requests. If you guys have any illustration requests, let me know. Otherwise, we take illustration requests live during this actual live stream. So appreciate you guys joining us this week. Look forward to meeting with some of you guys. If you have some stuff you want to go over offline, you just sign up for a Zoom meeting with me. There's no cost. Ravi, hey, how's it going? You're welcome. I love doing this stuff. Like, I really get a lot of joy out of meeting with people and educating them one-on-one. It's obviously a lot more efficient for me to do it like this. And the things that we're going over now are things that I go over when I meet with people one-on-one. Like, we go over the different designs. What are the different benefits with the different carriers? Let's compare the two. Let's see what happens when we make this change. So like normally when I'm doing my Allianz illustration design, I'll show you the bad design. Or in fact, any of the policies I do, I like to start with the bad design, shows the high commission, and then we show the improved design, and then we show the best design. Because I want people to be able to recognize that when you're out working with any agent, it doesn't have to be with me. When you're out working with any agent, or let's say a family member comes to you and says, hey, I know you were talking about this or looking at this. What do you think of this? You might be able to recognize whether they're looking at a good design or not. And you might be able to help them avoid making a bad decision. Oftentimes I'll meet with people who are already working with another agent. They'll share the design with me that they got. And they may like that agent and want to work with that agent, but it's just not a good design. And I say, here's the good design. Tell them to copy this. And then you can work with them. You get a good product. It might be a family member that they want to help out. They don't need to work with me to get that best design. I'm not all about that. I went over my business model recently. I think it was last week in one of our live streams. I put that up as its own video, basically explaining why I'm doing this and how our business model works. My business model is not reliant on me working with every customer out there. You know, I don't need to work with every customer out there. I make plenty of money on the minimum commission designs that we do because we get plenty of clients that decide they would like to work with us. That leaves me with enough time that I can meet with other people, that I don't have to make a sale. And there should be no pressure when anybody meets with me, no pressure to make a sale. We're focused on sharing information, getting you educated. And ultimately, if you want to do business with me, great. I would love to do business with you. Obviously, I like to make some money, but it's not necessary that I make money on every single person that I meet with. Now, I get some people, I offer a paid consultation option. Some people take advantage of that option. I really appreciate that. They know that they're likely not going to make a purchase from me, but they value my time. And whether they do a paid option or free option, not a big deal in the grand scheme of things. But it's just nice to see when you know they're respecting your time. Not everybody can pay for time. You know, a lot of people we work with, they don't have the money to spend on a consultation, or at least they don't know the value that it could provide them if the only option was a paid consultation. That's why I offer the free consultations. There's a lot of people that I know I can reach out to and affect and help because I offer those free consultations. And it's just kind of like you put it out there and it works its way back to you. It's like karma. You do good things with no intention of making money off of it, and you end up making good money. Like that's how I approach this stuff. Oh, thanks, Chris. You asked some good questions. I appreciate your attendance. Thanks. All right. Well, with that, I think we're going to wrap it up for today. We'll be back Thursday. Also, during these meetings, one of these weeks, I'm going to be bringing on some of my team members, and they'll help. We'll be able to interact together. But my hope is that they'll be able to help do some designs, and we get to make sure that they're doing the optimized designs as well. They're going to learn. We're going to learn. You're going to learn. We're all going to get better at this stuff. None of us, I know a lot, but I don't know everything, right? We always have room for improvement. And the more we go over this stuff, I think the easier it is to recognize and our learning opportunities. So appreciate you guys joining me. We'll be back again Thursday live. Again, that'll be for Whole Life. And we'll do some Whole Life illustrations. So thank you, and we will see you then.